Hello everyone, welcome to the 172nd episode of me learning how to trade in Forex. So in the last episode we went through analyzing cash flow statements. The cash flow statement is a record of the cash generated and used by the company. So unlike the balance sheet, which is a snapshot of a particular point in time, cash flow statement covers a certain period specified by the company. So we usually see the following data under the following categories. So cash from operations, so this is the money generated by the company's normal business operations. Sometimes it may be further broken down into earnings, additional to cash, subtractions to cash. So this figure is important because it can indicate whether the company is able to make enough money to sustain and develop its operations, or if it has to rely on external financing. Then we've got cash from investing. This reports the company's sales or purchases of long-term investments, property and equipment. Cash from financing, so this details the company's corporate bonds and shares that have been issued or repurchased. Dividend payments to shareholders will also be listed here. So from the cash flow statement, the fundamentals is that if a company is consistently generating more money than it's using, it will potentially be able to do a number of useful things with the surplus, so the extra, such as increase its dividend payments, benefiting the shareholders. We've also got paying off existing debts, so reducing its expenditure on interest payments. And we've got repurchase shares, which can have multiple benefits. So the company might repurchase the shares for the following reasons. So reducing the number of shares owned by the private investors. So this lowers the amount that must be paid out in dividends, and the money saved can then be used to re-strengthen the business. So if also the company feels the market undervalues its business, it might buy back the shares, take advantage of this, possibly reissuing them once the price is corrected, so gone up basically. And reducing the number of shares in circulation helps boost certain ratios that are commonly scrutinized by the markets, such as earnings per share. So the announcements of an upcoming payback or buyback sometimes cause short-term investors to flock to the stock concerns in the hope that the improved ratios will trigger a rise in the share price. So IG also suggests comparing cash from operations with net income. So if the cash figure is higher, the company can be said to have high quality earnings. So in other words, a substantial proportion of the earnings from the business is being turned into cash. However, if the cash from operations is dwarfed by net income, might compare the company to a friend who takes home a generous salary each month, but never seems to have the money to buy a pint. So where's that all money going to and why? Unless there's a valid reason for that difference, it may imply that the company is operating inefficiently. So then we went through a lesson summary, and now we're on to understanding the income statement. So understanding the income statement. Understanding the income statement. Date is the 20th. Right, so in this lesson we'll look at the last of the financial statements you should scrutinize before rounding up by explaining how to put all your analysis together and decide what to trade. The income statement measures the company's financial performance over a set time frame. So the income statement measures the company's financial performance over a set time frame. It's based on a fundamental accounting equation. So this is based on a fundamental accounting equation. So which is income equals revenue minus expenses. Effectively, the income statement is an accounting scorecard that illustrates the future profitability of the business, comparing the value of sales made with the cost of making them. So the income statement is an accounting scorecard that illustrates the future profitability of the business comparing the value of sales made with the cost of making them. Comparing the value of sales made with the cost of making them. Clearly, if making a sale costs you more than you earn from it, you have a fundamental flaw in your business model. You might see the following items listed in the income statement. So the following items might be listed in the income statement. So net sales, the sales of goods and services to customers. The sales of goods and services to customers. Cost of sales, the cost of producing the products sold. A manufacturer, for example, would include raw materials, labor, and manufacturing overheads. So, cost of sales. The cost of producing the products sold. The cost of producing the products sold. Gross profit. Defined as the total revenue minus the cost of goods sold. The total revenue minus the cost of goods sold. Selling, general and administrative expenses. So, whoops, let me just go up a bit. Selling, general and administrative expenses. The company's operational expenses. The trend of these expenses is viewed as a good guide to the efficiency of the management team. So, the company's operational expenses. The trend of these expenses is viewed as a good guide of how efficient the management team is. The trend of these expenses is viewed as a good guide of how efficient the management team is. Operating income. So this is the company's earnings before interest, expenses, taxes and special items. So the company's income or earnings before interest, expense, taxes and special items. Interest expense demonstrates a company's borrowings. Pre-tax income. Earnings before income tax. This is a good indicator of profitability. Earnings before income tax. A good indicator of profitability. Income taxes. An estimate of the income taxes that company expects to pay for the stated period. An estimate of the income tax that the company expects to pay for the stated period. Extraordinary expenses. Write-offs against income, for example, from restructuring or discontinued operations. Write-offs against income. Net income, the bottom line, demonstrating the company's profitability or its losses. Net income, the bottom line, demonstrating the company's profitability or demonstrates the company's profitability or losses. Completing your analysis. So having studied all the data and other information surrounding the company, finally it's time to put it all together. As you remember, the objective is to value the company so you can assess whether it currently seems overpriced or underpriced. By this point, you should be forming an opinion about whether the company seems positioned for growth or not. Does it have hidden potential, or are there pitfalls in the road ahead? Essentially, you're looking to uncover any factors that may influence the company's future, which haven't yet been taken into account by the markets. So, putting everything together, the objective is to value the company so you can assess whether it currently seems overpriced or underpriced. So you can assess to see whether it's currently over or underpriced. By this point, you should be forming an opinion about whether the company seems positioned for growth or not. Does it have hidden potential, or are there pitfalls in the road ahead? So, you should be forming an opinion about whether the company is headed for growth or not. Does the company have any hidden potential? Is there any pitfalls ahead? Essentially, you're looking to uncover any factors that may influence the company's future, which hasn't yet been taken into account by the market. So, you're looking to uncover any factors which may influence a company's future that hasn't been taken into account by the market. This stage of the analytical process isn't an exact science. It's more of a case of sitting back and considering all the evidence as a whole, being as objective as possible. While gut feeling could play a part, it's vital to consider whether you're allowing any personal bias or emotional attachment to sway your judgment. For example, we all have our favourite brands, but your love for a particular company's product doesn't automatically make the stock a good investment. Don't let emotional attachment or personal bias ruin the judgment. You can find out more about avoiding biases and other emotional aspects in our course, The Psychology of Trading. Picking stocks. Over time, you develop your own preferred methods for choosing what to trade. Opinions differ about which data and ratios are the most significant, although some are commonly considered important. For example, we mentioned the debt/equity ratio earlier in this course, and you might also look at price/sales. a valuation metric calculated by dividing a company's market capitalization by the most recent revenue number. As the level of share price is central to the fundamental analysis, many analysts use ratios that include the current price. Keep in mind that a company's stock price is equal to its market capitalization divided by the number of shares issued. Is equal to its market capitalization divided by the number of shares issued. So yeah. Okay. So level issued shares is equal to the market capitalization divided by the number of shares issued. Yep. Okay. Acting on your analysis. Having selected a share that you believe shows potential, the only remaining decision is how to trade it. There are two aspects to this. Will you go long or short? Will you make a short-term trade or invest for the long term? Wait, hold up. So, I think there's something I should be writing over here. Decide on the important ratios and data to look at. Although I don't think I should be writing this bit because everyone's got their own different opinions of whether what's important or what's not. As the level of share price is central to fundamental analysis, many analysts use ratios that include the share price. So many analysts use ratios that include the share price. Current price, not the share price. Keep in mind that a company's stock price is equal to its market capitalization divided by the number of shares issued. Company stock price equal to market capitalization divided by number of shares issued. Okay. So acting on analysis, having selected a share that you believe shows potential, the only remaining decision is how to trade it. There are two aspects to this. Will you go long or short, buy or sell? Will you make a short-term trade or invest for the long term? So after selecting a share which you think has potential, decide to go long or short or make short-term trade or invest for the long term. Decide to go long or short and trade the short term or invest for the long term. The first is simply a case of deciding whether you expect the share price to rise or fall. The second depends on both of your own goals, fast profit or gradual growth and dividend income, and on your expectations of the company. Question: let's say you're looking to trade in the short term rather than holding a stock for long-term investment. You've carried out analysis on two companies that both appear to offer potential for future growth. Company A has shown a sustained trend of gradually rising earnings over the past 5 years. Company B's net income was recently hit by extraordinary expense, spooking investors into a flurry of selling that has hit the share price. Which of these stocks is best fit for your objectives? Company B, isn't it? Because Company A shows it's good for long term, because the gradually rising earnings is over the past 5 years, so it's not really that quick, to be honest. Whereas Company B is it's pretty recent, isn't it? It's not like a long term thing, it's like a really short term. So if you're trying to trade in the short term, go short on Company B. You could reasonably expect the price of Company B to recover quite rapidly, making the stock ideal for short term trades. Company A will be more suitable to buy for a long-term investment as it's likely to deliver steady, gradual growth. Oh, never mind, you don't go short on Company B. So you expected it to recover quite rapidly. Right, okay. Let's do a summary then. An income statement is an accounting scorecard that measures a company's financial performance over a set time frame. It's based on the equation income equals revenue minus expenses. It compares the value of sales made with the cost of making them, so you can use it to forecast the future profitability of the business. Round up your fundamental analysis by reviewing all the information and data you've gathered and considering the full picture it presents. Form an objective opinion on whether the stock has potential movement and appears worth trading. Form an objective opinion on whether the stock has potential for movement and appears worth trading. Cool. The pros and cons of fundamental analysis. The pros and cons of fundamental analysis. Carrying out detailed fundamental analysis requires an investment of your time and efforts. So is it worthwhile? To help you decide, let's consider some of the strengths and weaknesses of this type of analysis. Strength of fundamental analysis. Fundamental analysis can help you do a number of things. Identify long-term trends. So pros of fundamental analysis. Identify long-term trends. Well, let's just be a new line. Whereas technical analysis generally only identifies short-term patterns and opportunities, a fundamental approach will highlight companies worth of longer-term investment. This might suit you better if you're happy to take a patient view and prefer not to incur repeated dealing charges. A fundamental approach will highlight companies worth of long-term investment, companies worthy of long-term investment. This might suit you better if you're happy to take a patient view and prefer not to incur repeated dealing charges. Spot value stocks. Solid fundamental analysis can enable you to identify companies whose share price undervalues or overvalues their real worth. Investment in companies like this is known as value investing, and it's an approach that has been championed by many of the world's leading investors such as Warren Buffett. Identify companies whose share price undervalues or overvalues their real worth. Help you identify companies whose share price undervalues or overvalues their real worth. Investing in these companies is known as value investing. And it's an approach that has been championed by many of the world's leading investors such as Warren Buffett. Value investor Warren Buffett. Develop your business acumen. Your business acumen. By carrying out comprehensive analysis of a number of companies, you'll build up a thorough understanding of the way these businesses work, getting to know their industry sector and what drives their revenue and profits. This can be invaluable, helping you to recognize which companies to avoid and when it's the right time to enter and exit a position. As you become familiar with studying balance sheets and income flows, you will also get a sense of the varying levels of volatility and risk that apply to different companies and sectors. For example, tech stocks are generally viewed as being more volatile, exposing you to higher risk than, say, utilities. So, by carrying out comment, you build up a thorough understanding of the way these businesses work, get to know the industry sector and what drives the revenue and profit. So, through comprehensive analysis on numerous companies, you'll build up a thorough understanding of the way these businesses work. You'll build up a thorough understanding of the way these businesses work, getting to know the industry sector and what drives their revenue and profit. Getting to know their industry sector and what drives their revenue and profit, and what drives their revenue and profit. This can be invaluable, helping you to recognize which companies to avoid and when it's the right time to enter or exit position. So this can be invaluable as it helps you to recognize which companies to avoid and when it's the right time to enter or exit position, and when it's the right time to enter or exit a position. As you become familiar with studying balance sheets and income flows, you also get a sense of varying levels of volatility and risk that apply to different companies and sectors. So you'll also get a sense of the varying levels of volatility and risk that apply to different companies and sectors. For example, tech stocks are generally viewed as being more volatile, exposing you to higher risks than, say, utilities. Categorize shares correctly. Shares correctly. Business is constantly subject to change, and companies can rise to success or fall from grace as their environment evolves. An understanding of a company's business gleaned through fundamental analysis can help you categorize it correctly as a well-managed, well-resourced entity that's positioned to flourish in a changing environment, or a flawed, inflexible organization that will struggle to adapt to a shifting landscape. Business is constantly subject to change. Understanding the business through fundamental analysis can help you categorize it correctly as a well-managed, well-resourced entity that's positioned to flourish in a changing environment or a flawed, inflexible organization that will struggle to adapt to a shifting landscape. This in turn will help you to work out its relative valuation in the face of changes within the industry. So this helps you to work out the company's relative valuation in the face of changes within the industry. In the face of changes within the industry. The weaknesses of fundamental analysis. So, cons of fundamental analysis. Fundamental analysis also has certain drawbacks. Could take a long time to pay off. While fundamental analysis might help you identify companies that have been overpriced or underpriced, it won't necessarily reveal the likely timescale before the share price moves in line with your assessments. So unlike technical analysis, where the movement to buy or sell can often be predicted on the charts, there's no way of knowing how long it might take to secure a profit. Fundamental analysis won't necessarily reveal timescale, undervalued or overvalued companies. Won't necessarily reveal the likely timescale for the share prices of undervalued or overvalued companies reveal the likely timescale for the share prices of undervalued over moving in your prediction. Fundamental analysis won't necessarily reveal the likely timescale for the share prices of undervalued or overvalued companies to move in your prediction, to move in your predicted direction. There's no way of knowing how long it might take to secure a profit. Therefore, there's no way to know how long it takes to secure a profit. No two sectors are the same. No two sectors are the same. The way you assess a company's value will depend on the sector it belongs to. This means each time you look at a new company in an unfamiliar sector, you probably need to use a different approach altogether. This may mean, in the interest of time, you'll need to restrict yourself to just one or two sectors. So, the way you assess a company's value will depend on the sector it belongs to. So each time you look at a new company in a unfamiliar sector, you'll probably need to use a different approach altogether. You'll probably need to use a different approach altogether. So this could mean that you'll need to restrict yourself to one or two sectors in the interest of time. Objectivity can be impossible. So being objective can be impossible. When calculating the fair value of a company, you often have to make assumptions about variable factors, interest rate expectations for example, or government taxation policy. But these assumptions are by nature entirely subjective. The most you can do is consider multiple scenarios and outcomes to allow for the fact that your view may be overly optimistic or cynical. You will often have to make assumptions about variable factors when calculating the fair value of a company. You'll often have to make assumptions about variable factors when calculating the fair value of a company, e.g. interest rate expectations, for example, or government taxation policy, or government taxation policy. But these assumptions are by nature entirely subjective, so they're opinionated. These assumptions are subjective. The most you can do is consider multiple scenarios and outcomes. So consider multiple scenarios and outcomes to allow for the fact that your view may be overly optimistic or cynical. To allow for the fact that your view may be overly optimistic or cynical. So I say cynical. Companies spin their own news. Spin their own news. Most of the information fundamental analysts use to assess a company comes from the company itself. By hiring investors relation managers, these businesses ensure any releases reflect as positively on their performance as possible. It's worth bearing this in mind and taking their announcements with a little pinch of salt. So don't trust it all the way. Most of the information used in the fundamental analysis comes from the company itself. Investor relations managers. Companies can hire investor relations managers to ensure any releases reflects as positively on their performance as possible. So bear this in mind and take the company's announcements with a pinch of salt. Lesson summary then. Fundamental analysis will help you to identify long-term trends and opportunities. So identify long-term trends and opportunities. Spot value stocks to trade. Okay, develop your business acumen. Categorize and value shares accurately. categorize and value shares correctly. However, it could take a long time to pay off. Supporters remember that no two sectors are the same. Objectivity can be difficult or impossible. You'll need to look beyond the spin companies put on their news. Companies spin their own news. So look beyond the spin companies put on their own news. Look beyond the spin companies put on their own news. Okay. I'm gonna leave this episode here. So in the next video we're gonna start off with the quiz, and yeah, we'll carry on with whatever the next online course will be. So I think there's one more course in the intermediate section, and then after we've done that course we can move to the advanced one. So very good. So yeah, as I said, next video gonna start off doing the quiz and finish off this fundamental analysis lesson. So thank you all for watching, and I'll see you guys in the next video. Bye bye.